Hello everybody. So today I want to go way out on the risk curve and tell you about looping STRC. Looping is the word that Saylor used at the Bitcoin conference to define kind of the carry trade. Some people call it rehypothecation. It's got many multiple names, but the whole idea is to use leverage on an instrument like Stretch. And that's why I say I'm illustrating this, trying to be as concrete as possible, kind of like an anti-jack, if you know, you know, trying to be as concrete as possible as to how this works. How does this concretely works? What do we mean that we could potentially get more than 11.5% yield on Stretch, thanks to leverage, thanks to carry, thanks to rehypothecation, thanks to quote Saylor, looping. So let's go. So let's imagine you have option number one, and of course, to picture this, you need to have a broker with margin enabled, and margin needs to be close to SOFR. That's essentially Robinhood, right? Robinhood interactive brokers, they're going to have margin close to SOFR. SOFR is the overnight yield, right? The overnight yield, which is set by the Fed. But anyways, okay. So imagine you have $100,000 in cash. You take that $100,000, you put it into Stretch, you do nothing else. No leverage, you earn 11.5%. Now let's imagine option number two. You put $100,000 in cash, and you decide to borrow 100%. So you decide to use it as collateral. You borrow 50%, which is typical for margin. So you actually buy $200,000 worth of Stretch with only $100,000 of cash, and $100,000 which you borrow. And you borrow that $100,000 because you are going out and buying $200,000 worth of Stretch, which will serve as collateral for the borrowed tranche. And that's how you're able to get such low yields. So let's imagine that. So you have $100,000 in cash. You just bought $200,000 worth of Stretch by borrowing 50%, borrowing half. Very common trade with margin. Your first 100K tranche, you would earn 11.5%, and your borrowed tranche on 100K, you would earn 11.5% minus 4%. So that means you would earn 7.5%. Now, of course, the borrowed money is not your money. The borrowed money, you got to pay for it, but the delta between the money earned on the borrowed money and the interest paid on the borrowed money, that delta is yours to keep. So what's the total yield if you were to do that? Total yield would be 100K, right? Plus 100K of carry, 100K plus 100K of carry. That would be 19% initial yield. On your first 100K, you would earn 19% yield. Why? Because on your own 100K, you earn 11.5%, and then you earn 7.5% on top, which is the yield that you earn on the borrowed money. It's your arbitrage. It's the arbitrage money. So 19%, right? Pretty good. Now, what if you were to borrow 2/3? What if you were to borrow 2/3 of the money, which you can also do with pristine collateral? So let's assume that $100,000 in cash, you borrow 2/3. That means you buy $300,000 worth of Stretch. The first tranche, of course, is yours. That's your money, 11.5%. And then you borrow 200,000, and you earn on that. You're going to yield out on that. You're going to arbitrage on that, 11.5% minus 4%. That's 7.5% times 2, 100 plus 100. So total yield on your initial 100K when you borrow 2/3 to buy Stretch. So you have 200K worth of carry, worth of a borrowed tranche. That's 11.5% plus 7.5% plus 7.5%, which means that it would get you to 26.5%. Crazy, right? Crazy. So what's the catch? What is the catch? Well, here is the catch. That's the key concrete problem. Can you do this right now? And my guess is you can't. You most likely can't. And this is where I have homework for my regular viewers. Check your broker and tell me what's your maintenance ratio. Your maintenance ratio on the STRC is likely going to be 50 to 75%. which I suppose is better than nothing, but it's really not good. It's really, really not that good. Like, you know, I'd rather stay safe than do that, right? It's not that good. You can't borrow right much right now. So look at the maintenance ratio in STRC and compare that maintenance ratio to old world, seasoned, well-accepted asset like PFF, which is a preferred ETF, preferred stock ETF from iShares, or BND, which is the Vanguard Bond ETF. And my guess is that you're going to have 25% on those two. So traditional brokers treat ETF like BND as pristine collateral. They treat the S&P 500 as pristine collateral. They still treat STRC as pretty darn bad collateral. So mine for STRC is actually 50%. But for me, STRC on my broker is totally not well treated. Because why? Because I own a lot of super volatile stocks, like HIMS, like Strategy, like Tesla. If you have a broker with a long-standing relationship, well, I have that. But, you know, if you have a broker, say, with a boring portfolio, like a bunch of bonds, S&P 500 ETFs, yours might be lower. So check at your broker if you can borrow 25% maintenance ratio, initial maintenance ratio. Well, initial is going to be higher, but your maintenance ratio is at 25%. Check that on the broker, right? And let us know in the comment section. And here's another thing. So you may know your broker with Rec T. It makes its own specific calculation based on its requirements. So this is another homework for the viewers. Is compare your long buying power as a sum in cash, your long buying power for a pristine collateral asset like BND, and then compare your long buying power for adding STRC to the portfolio. And so you will see your maximum buying power for STRC, and then you will see your maximum buying power for BND. And then tell me in the comment section, STRC to BND, what is the ratio? So what's the percent of BND's buying power are you granted for STRC? So in my case, for STRC, I am only granted 41% of the buying power that I am granted for BND. So in other words, the broker treats STRC not favorably at all. Like it almost treats it as 3 times as risky as BND. So if you want to help the community, maybe post in the comment section what's that calculation for you. My guess is that STRC is just generally not going to be treated as pristine collateral, which makes looping kind of pointless, and I'd rather own volatile MSTR stock. As you know, these preferred, I don't really like them. I'd rather own Bitcoin. I'd rather own MSTR stock. MSTR stock, by the way, has a 25% maintenance ratio. But these assets, for now, they don't have the history of a broker. So these assets are really interesting if you want it for the yield. They can't really be looped just yet, at least in my view. So to me, that's not interesting right now. To me, a looping actually works better on something like a BND. And of course, I think a lot of people do that. And you know, even then, you could actually do it on BTC. Actually, some Bitcoin ETFs provide a max buying power. Like I'm available, the max buying power is possible for some BTC ETFs as far as my portfolio is concerned. So like the HODL one, the VanEck one, for example, is really, really favorable. Like when you want to buy an asset, check the buying power per asset. It's going to be different depending on the asset, and that's the risk. That's whatever risk your broker thinks this stock is. Your broker may absolutely dislike certain stock and may love other stocks, and so that's something you need to keep in mind. But anyways, okay, let's how would looping be interesting for STRC? Well, Saylor needs to improve the creditworthiness of STRC, and that's going to come with time. But how do you increase the creditworthiness of STRC? First of all, make sure the peg stays at 100 for a long, long time. Okay. Point number 2, and I think this is the most important point. STRC needs to be more than 1 year old. It's not 1 year old yet. I think when STRC becomes more than 1 year old, come August, we might actually see more favorable treatment from brokers. But right now it's less than 1 year old, so I think it's in the penalty box because of that. And then lastly, how do you increase the creditworthiness of STRC? For those interested in looping it, how do you do that? Try to increase the credit rating. Try to move away from junk. And I think that will be last to happen. I think that will take forever to happen. TradFi is very trad. That's it. It's very traditional. It's not interested in that sort of stuff. It's kind of crazy. Anyways, here's another thing also, which could be very interesting. If you wanted to do looping, then in that situation, a diversified ETF of Bitcoin-backed preferred would be very helpful. Because if there were more of these DATs issuing these ETFs, and if there was like a low-fee diversified ETF, which just held them in a packaged way, in an indexed way, I think the broker would also treat this more favorably. So I do think we're going to need a low-fee ETF to aggregate all of the prefs in one instrument at one point. And when we get that, we're going to have a better collateral status. Now, the problem that if you do that is that you lose the tax-deferred treatment. You lose the tax-deferred treatment. Now, it depends how you construct your portfolio. Because tax deferred doesn't mean it's not taxed. Like, you're gonna be taxed either way, but that means you're gonna compound less fast in the early days. You're going to compound less fast in the early days if you are taxed right away. I guess that's one of the main downside of tax deferred versus regular tax is the speed of compounding. But nonetheless, if you ever sell stretch, you will be taxed. So the tax, I would argue, is a medium importance argument against owning an ETF. It's not of the utmost important because tax has to be paid if you sell it. And even if you want to hold STRC forever, once your cost basis is zero, you're going to have to pay tax on whatever sum after 9 years or something. So a little bit of a problem, right? Because you would lose the tax benefits if you did that, but you could justify it if actually you had an ETF who held SATA and STRC and who was treated most favorably by brokers. Not the case right now for STRC. Now, let me conclude with risks. Well, I'll finish with the Wild West, actually. But let me first talk about risks. This is risky. I would not do that. I am not going to do that. This is not something that I do. I mean, I hate dividends. I'm not a yield investor anyways. I do understand why some people do it, right? If you're in your 70s, I get it. I entirely get it. If you're in your 70s and say you have heirs and you want to pass down a limit up basis, like a cost up basis, like a higher cost basis, I see a lot of benefits doing this for a retiree, for example. It's just to me, yield is not interesting. So I wouldn't do it. I'm not interested in that. But for those who are interested in doing it, you need to be aware of the risks. So I see one very big risk and I see a smaller risk. One very big risk is liquidation on a major depeg. What if we had, kind of an end of the world black swan type of event again, right? And STRC were to crash to 92 or 89. Well, if you're levered to the max, that could be enough for you to be liquidated. And you could have, of course, systemic collapse, systemic liquidations, cascading liquidations. And of course, that was the big fear of the Japan carry trade when Japan started increasing the rates, because people had looped it way more than once. Hedge funds, not people, right? Hedge funds had looped it way more than once. So the DPEG is one problem. Another risk, which of course is a big risk for those doing the Japan carry trade. That's a big risk. That's less of a risk for us, but still a little risk is SOFR. What if SOFR increases and STRC demand is through the roof and the yields drop, right? What if, for now, we're pretty far from that delta, that arbitrage being gone. For now, you would need a lot of things to go wrong for this arbitrage to be gone. But then again, why do you think Powell is staying at the Fed against all sorts of customs? Let me tell you why. Because hawks want to hike. Hawks want to hike. People, hawks, they want to hurt the job market for the sake of CPI ideology. Hawks want to hike. You saw the dissent. 3 dissents at the Fed meeting today. They want to hike. For the sake of saving a basket of CPI, for the sake of CPI ideology, which is so rooted in the field of gerontology, for the sake of CPI, anyways, in the field of geriatrics, they love CPI. And they're willing to crash everything for the CPI, for the sake of the CPI. Because the CPI is representative of like the perfect person, right? A CPI basket is totally a normal person. No, CPI represents nobody, but it's ideology, and you saw the descent at the Fed. So why do you think Powell is staying? Because hawks want to hike, and Powell probably is a hawk, as polished as he is, right? And they don't like that the new chair is coming. He probably is gonna think about dropping rates. They don't like that. So, anyways, that's a risk, right? SOFR could increase, and if SOFR increases at the same time as I don't know. Stretch, say, gets insane demand from DeFi, then Saylor could drop the yield, and then you could become in a situation where you need to close the trade. Okay, so these are the risks. How do you mitigate this risk? Well, there's one simple risk to mitigate that, is to have non-mark-to-market debt. But then again, if you have non-mark-to-market debt, why wouldn't you just buy Bitcoin, right? Or strategy. Right, it's like that's my point, right? But of course, if you want to avoid the liquidation risk, the HELOC is a way to do it, right? If you get a HELOC, you paid for a house, you get a HELOC on the house, you borrow at 7-8%. I mean, mortgage are like a 4-week high, so it's probably 8% now for a HELOC or something like that. Some people do it, of course, the classic 0% credit card and looping the credit card and playing the balance transfer game, and it's what is it, pedantic. I want to say it's like a very annoying like. Anyways, it's so administrative. It's such a pain to do that, right? But of course, if you follow this thing of 0% cards, I mean, for example, in real estate, I don't look at real estate very much, but some people have found ways sometimes to buy an entire house and flip an entire house and put it on 0% credit cards. So, and there's aggregators and there's things that you can do. But nonetheless, whether it's a HELOC, whether it's a 0% credit card, whether it's like a low-cost personal loan or something like that, it's non-mark-to-market debt. So you're not going to be subject to liquidation. And therefore, it could be a little less risky. A little less, I suppose. But to me, that's not my game, right? I'm not interested in this game. I believe in Bitcoin, the asset. But you understand why this is appealing. And I'll conclude with the Wild West, still today, the Wild West. Looping on DeFi. So looping on DeFi, and you can see that there's a lot of demand. Saturn being the second biggest stretch on DeFi. APYX is the number one. APYX has more than that. Saturn reaching 100 million, by the way. So a lot of people are seeing a lot of benefits on this because then they can leverage it on the DeFi sector, right? And you can see APYX 12.9% because they own a little SATA in there. Strata, this one seems to strap the volatility, so this one may be on the lower end of a risk. And of course, STRC is not on Hyperliquid yet. And keep in mind, I'm in the US, so it's like I don't have any access to Hyperliquid. I mean, I could use a VPN, but no. Anyways, this is all I can see on Hyperliquid. You see, Hyperliquid already has STRK with 5x leverage. My guess is that at some point we're gonna have STRC with leverage on Hyperliquid. The fact that Hyperliquid has 5x leverage on STRK is already much higher than what you can get on any broker. So actually, you could have a lot of demand for the carry trade done on the DeFi side of the picture and not necessarily on the TradFi side of the picture. And my guess is that a lot of DeFi protocols might actually be okay actually granting you more leverage on STRC because they may be more prone to, looking at STRC as a credit-worthy instrument. So anyways, this is financial engineering. This is risk. And there's different flavors of risk. And to me, I love Bitcoin. I love MSTR. I don't do these preferreds. I understand why people do the preferreds. I understand why they like it. I don't. But to a certain type of investor, and especially to a parametric investor, I like that word, parametric, to an investor who doesn't want to take directional risk, That could be very interesting. So anyways, hopefully this gave you some very concrete stuff. Please do that exercise. Go tell me your long buying power for BND and for STRC and express it as a percentage, of course. Don't tell me the sum, but express it as a percentage. And I want to see how it is for other people who may not have as risky of a portfolio that I have. Because my portfolio is super risky. So for me, they don't even begin to think about letting me do a carry trade because my portfolio has too much risk. But if you have a very low risk portfolio, maybe you can borrow to buy stretch much more than I can. And again, I said that before. This is definitely not something I would do. This is not my style of investing. This is hedge funds. This is carry trades. This is not me, and keep in mind the risks I presented. But anyways, this was not investment advice. This is not financial advice. This is only entertainment. I hope you were entertained. Please subscribe, follow me on Patreon, follow me on X. Thank you for watching, and have a wonderful, wonderful day.